In this presentation, we'll evaluate preference shares as a source of capital and its cost to company as well as the benefits to the issuers. I am Aninda Datta, the presenter, and my contact details are given here. Now, what is a preference capital? How preference capital is different from the equity and debt? Why a company issues preference capital? Benefits of preference capital to the issuers and the investors. Different kinds of preference shares, various characteristics of preference shares, taxability of preference dividends, tax benefits of investing in preference shares, cost of preference shares, convertible, redeemable, etc., methodology of calculating preference shares cost, behavior of preference share price, major preferred stock index and historic returns. Preference shares, also known as preference stock, are a type of company stock that gives shareholders certain preferential rights over equity shareholders. The characteristics are as follows. Benefits and disadvantages to preference shareholders. Green indicates advantages, red indicates disadvantages, and brown indicates neutral. Entitlement to assets. In the event of bankruptcy, the preference shareholders are entitled to share in the company assets before equity shareholders. Voting rights. Preference shareholders enjoy no voting rights or less voting rights compared to equity shareholders. Share price movement. Share price moves more with market interest rate than with company's performance, so are less volatile. Dividend backlogging. In case of non-payment of dividend due to insufficient profit, the backlog dividend needs to be paid to holders of cumulative preference shares before payment of dividend to equity shareholders. Fixed dividend. In case of high profits, the dividend on preference shares remains fixed. Dividend priority. Dividend is paid at predetermined rate to preference shareholders prior to the equity shareholders. The main reason why companies issue preference shares is to raise capital without diluting control. Now, what are the reasons why company choose preference capital? The company wants to raise money by fixed payment obligations but does not have enough assets to mortgage for issuing bonds. Flexible financing. Preference capital could be structured in different ways like cumulative, convertible, redeemable, etc., giving company flexibility in managing capital structure. Enables companies to keep obligations fixed without deteriorating the debt to equity ratio. A low debt to equity ratio drives higher equity valuation. Enables raising short-term capital by issuing redeemable shares. Could shift from fixed obligation to equity shares by issuing convertible preference shares after a fixed period. Now, the reasons why investors choose preference capital. Risk-averse investors can get assured dividend with less risks, plus they rank above equity shareholders in case of liquidation. Investors in the high income tax brackets could reduce tax liability in those jurisdictions where dividends are taxed at concessional or zero rate. The price volatility of preference shares is much less than equity shares, as those move more with market interest rate, so suitable for risk-averse investors. Redeemable preference shares enable investors to look into investment for a predetermined period with a predetermined redemption price. The preference share is deemed to be cumulative, non-participating and non-convertible unless otherwise stated. Now let's examine the classification of preference shares on the basis of characteristics. Cumulative preference shares entitle the shareholders to dividend payouts even when there is no sufficient profits. Non-cumulative preference shares. Here the company decides whether the shareholders are to be paid dividend in case of insufficient profits. Participating preference shares. The shareholders can demand extra dividend if the company has surplus profit after paying dividend to common shareholders. Here the share price is also influenced by the company's performance. Non-participating preference shares. The holders of these shares will only get predetermined dividend. They will not get share in surplus profits. Redeemable preference shares. These shares could be redeemed by a company at a predetermined time and rate. Non-redeemable preference shares. These shares cannot be redeemed by the company during its lifetime. So those could be redeemed only when the company closes down. Convertible preference shares. These shares could be converted into equity shares by shareholders after a certain period at a fixed rate. Non-convertible preference shares. These shares cannot be converted into equity shares. The shareholders receives fixed dividend during the company lifetime and preference dividend payout when the company is dissolved. Now let's examine the taxability of the preference dividend. As companies do not enjoy income tax deduction on preference dividend paid, the cost of preference capital is higher to a company compared to debts having the same coupon rate. Income tax treatment of dividend paid out plays a major role in making preference shares attractive to high income investors, as mostly dividend income is taxable at zero rate or at concessional rate. Dividend from companies are paid out of profits arrived at after paying income tax. Therefore, the dividends are usually taxed at concessional rate or at zero rate subsequently. Subsequently, dividends are taxed at two stages. Dividend distribution tax in the hands of the company plus or dividend is taxed at the hands of the recipient. Dividend taxability varies a lot with countries, but generally dividend is taxed at one of the two stages. In most countries, dividend is income tax exempt up to a certain limit in the hands of the recipient. In many countries, dividend is tax-free in the hands of the recipient. The corporate income tax rate plus the dividend distribution tax rate is less than the higher slabs of the personal income tax rates, thus making issue of preference capital an attractive proposition for both companies and high-income investors. Thus, preference shares are preferred by investors, especially in high income tax brackets, to reduce income tax liability. The companies gain by offering proportionate lower dividend than coupons on bonds to the extent of income tax savings to the investors. Now let's evaluate how to calculate the cost of preference capital to a company. The cost of preference capital to a company is the annual dividend divided by the net proceeds from the sale of the preference share. However, for calculating the present cost of preference share, the current market price is considered in the denominator, thus Kp equal to dp by P0, even though the dividend is paid on the face value. As the company does not get income tax deduction and preference dividend, so income tax rate is irrelevant in the calculation cost of preference shares. However, the cost could vary based on characteristics of the preference shares. In case of preference shares redeemable at premium, the premium needs to be added to the normal dividend-driven cost. The premium needs to be allocated to the life of the preference shares. Now, this is the formula for calculating the cost of redeemable preference shares. In a case where there is a premium on redemption, Kp is the cost of redeemable preference shares, R is the dividend rate, number of years, N is the number of years to maturity, MV is the maturity value of preference shares, P is the net proceeds. Just see how the premium on redemption is allocated to the life of the preference shares over its equally over its life. MV minus P divided by N. Adding some premium on redemption allows the company to issue preference shares with a lower dividend yield. The cost of redeemable preference shares could be calculated using the IRR method also, where the IRR discounts all future dividend payments to the present market price. In some cases, the company has an option to redeem the preference shares. In that case, the issuer bears the cost as it holds the redemption option. So the company has to pay higher dividend compared to plain preference shares. Now let's evaluate how to calculate the cost of convertible preference shares. In the first stage, the preferred stock is to be priced as if no conversion clause exists. So the first question is to be examined is the conversion compulsory or an option to the shareholder? And the cost is to be calculated differently under each situation. Now first examine the cost when the conversion is compulsory. Here the cost of preference share depends on the comparison of conversion price with the market price. If the conversion price is lower than the market price, the preference share price goes up and the dividend yield goes down. If the conversion price is higher, then the dividend yield goes up. Now let's examine the second situation where the conversion is an option to the shareholders. Since the conversion option is held by the shareholder, so the cost of option is to be borne by the shareholder. The conversion option is to be priced considering the predetermined conversion price, the time to conversion, the volatility of the equity share. The conversion could be priced using Black-Scholes method, binomial method, one of the two methods. As shareholder bears the cost, so the company pays lower dividend on the convertible preference shares. The dividend yield is calculated considering as if the company does not receive the cost of option. Suppose a company could issue normal preference shares at 8% dividend yield. The conversion option cost is 10 rupees as per the Black-Scholes method on the face value of 100. The new dividend yield would be 9 into 8 divided by 10, that is 8% on 90, that is 7.2%. Now let's evaluate how preference share moves in the market. Share price moves with the market. Preference share price moves more with the market interest rate than with the issuer company's financial performance. Now this is the Standard & Poor US Preference Stock Index movement over the last 5 years. The Standard & Poor US Preferred Stock Index price return is minus 2.67% over the last 5 years. The Standard & Poor US Preferred Stock 5-year total return is plus 3.63%. Thus, the dividend yield has been approximately 6% over the last 5 years. As could be seen, the period between the two lines, the period from 2021 to 2026, the price index moved downwards, coinciding with the major interest rate cycle in the world, especially by the Fed. The rate hike cycle affected by the Fed during this period, so the preference stock index has gone down during that period. So it behaves more like a bond. Its price movement behaves more like a bond than like an equity share. In India, the corporate income tax is 25% and the most dividends are taxable in the hands of the recipient. So preference share is not very tax efficient method of raising money, as total tax on the entire chain is more than the highest personal income tax slab. Moreover, the most bonds are secured by assets mortgaging. So investors would prefer bonds compared to the preference shares. So companies need to offer some other benefits to investors in India, like high dividends, conversion to share attractive prices, etc. So this concludes this presentation. Thanks for watching.